rate hikes not being anticipated, but the markets really loved the expectation that rate cuts were coming based on the dot plots from the statement of economic projections, which we'll talk about. We had a massive rally in bond yields, which dropped sharply. Equities rallied with a breadth we haven't seen for some time. And I suspect the odds of the market being disappointed going forward because of their exuberance about the rate cuts, I think the odds of them being disappointed are a lot higher than we'll see the likelihood of a rate cut in March, or that they've moved to where the Fed dot plot said 3 cuts next year to expectations of 6 cuts potentially from the market. So when I said the Fed had a communication challenge before the meeting, they now have a bigger one after, and we'll talk about that. So the top quote was from Powell last week, where he thought that we've gotten to a sufficiently restrictive place. And he still said that, but he doesn't think that we can be as eager to bring down rates because the path to bring down rates is not as clear as it might have been. So what changed since the meeting and what got the market so excited is the inflation expectations have come down, and we'll talk about that more in a minute. They upgraded their growth for this year. And if you remember, Q3 was a 5.2% growth, but the Q4 numbers were projecting to be quite low, under 1%. That's actually rebounded a bit, and now they're looking at a stronger growth for the year of 2.6%, but they still have it dropping to 1.4 next year. Employment has been really strong, and the unemployment rate only moving up 0.4% next year is not a big move, and certainly something the market could absorb. But the dot plots that they put out suggested 3 rate cuts to end the year at 4.6%. I think that's going to be an outcome that's more gray than the market would like. I think there's a lot of, the market likes binary outcomes, and I don't think they're going to get one here. So here are the projections that the Fed puts out, and this is done with every meeting that they have. And you can see they look at the change in real GDP, the change in unemployment, the change in PCE and core inflation, and where they think the Fed funds rate will be. And they do it out a couple of years, and they do the longer term. So they have the median, the central tendency, and the range. And as you can see here, looking at the ranges for this year, pretty tight. When you go into next year for GDP growth, there's a range of 0.8 to 2.5%. So that's a big swing that you can see there. Similarly, with unemployment, you have a 0.6% swing in the range for next year, and similar on PCE, 0.6% swing. So this is really where the challenge comes from. If you interpret too much into the projections, you can be led astray. So let's go on to the famous dot plots. So the way the dot plots work, actually, and this is where the market might be getting ahead of themselves, is the voting members and the Board of Governors all put out their assessments for those areas that I showed you on the previous slide. And they do their projections based on where they see things in their region at this point in time. So it is a personal view of the federal board members and the Federal Reserve Bank presidents. Once that's out in the statement, and that's released when Powell does his press release and his release for the summary of the meeting, and they send the statement of projections out, the market saw that there were rate cuts coming for next year. What they interpreted was that those are fact when they're not. They're just a projection at the point in time when the guys were asked to vote and women were asked to vote on the market where they thought rates would be. And they were looking at a very slow economy at that time, a slowing of the economy, big global problems, and they put in more aggressive rate cuts. I don't believe that's going to be the way it plays out. And the market took this and ran with it. So this said 3 rate cuts. The market then moved to 6 rate cuts in the betting markets, with the first one coming in March. You'd have to see a lot change for the Fed to move off their policy between now and March. And I don't think it's normal economic activity. I think it would be more a exogenous event like war escalating in the Middle East or Ukraine or some other black swan type of event. So the stock and bond markets rallied, yields dropped a lot, which took a lot of pressure off the global system. You then had the other central banks saying that they're not looking at rate increases at this point, which takes a lot of the pressure off the system. And that does help with the inflation pressures. It does a little bit to ease cost of living, but cost of living is embedded now. We're still looking at 20% higher rates, even though inflation's slowing. Mortgage rates have come down sharply, which is a very big positive in the US. And the dollar easing has taken a lot of pressure off the global system, particularly those who had high dollar debts. And one of the things I think the Fed was concerned about is the dollar strength putting too much pressure on the rest of the system, and us having a big yield differential with the rest of the world would suck capital into the US at a rate that would put even greater strains on the emerging economy, making it harder for them to rebound and pay their dollar debts. So it's a very complicated global system right now with a lot of distortions that we're still dealing through from the pandemic, which makes it hard for the central bankers to have a binary view of what the world's going to be 12 months out or 2 years out. So, but the market did love it. As you can see, this is the chart of the S&P for the year to date. And you can see over the last couple of weeks how big the move has been. And it is pretty stark, and people are looking at a very positive outlook going into next year. The rally in the yield curve has been pretty significant too. So what I'm showing you here is the blue is where yields were on December 15th, 2 days after the announcement. The green is where it was a month before. That's a really significant move. And this highlights actually how unusual the global economy and the markets are working today. To see this kind of a move in such a short period of time is really startling. And then you look at where the red line is where we were a year ago and how big a move up we've had of a 0.5% move. So for all the gyrations where we went from, on the 10-year where it went up to, 5%, now back down to under 4, and we started the year at 3.5, you can see just how big the distortions are in the economy and how much uncertainty exists. The ECB held their rates as well, but I think there's less certainty that they've solved the inflation problem. And I think that's why you're looking at the markets where they are, although there is a much more positive tone towards Europe right now. I think that one of the risks that's still out there is the energy problems, and I don't think we've solved them. And I think Russia's sitting there thinking that if they drag things out and then put some pressure on with energy prices, they could really wreak havoc on the global system. And then you look at the UK also leveling off rates, but I don't think they believe the inflation fight's done there yet either. And I think in both cases, they could see energy prices move up, which would actually change the dynamics for the inflation outlook considerably. And I think that's where we are today. So while people are happy with where the central bank policy announcements were, I don't think they can be quite as thrilled as the market's reaction has been. So I think the market might have gotten a little ahead of itself. I won't say that that's the case all the way out through next year, but I think the ride will be bumpy. So then the Fed goes into full communications adjustment mode. So 2 days after the press conference that Powell had, where the markets got really excited, and then the markets took it from 3 cuts to 6 cuts. John Williams, who's arguably one of the 3 most powerful central bankers in the US with Powell and Lyle Brainerd, as the New York Fed Reserve president, comes out and says that the market's gotten way ahead of itself. Raphael Bostic, who is the president of the Atlanta Fed, came out with the same comment. Austin Goolsbee of the Chicago Fed came out on Thursday or Friday with you could see how we could get to rate cuts, and then came out over the weekend saying you could see that, but you could also see how we could have higher rates. So maybe we're not going to be go as quite as far as the market thinks we are to ease. I think you then had Mary Daly, the San Francisco Fed president, say that she put in for rate cuts for next year, but not as aggressive as the market has. And Loretta Mester from the Chicago Fed also said the same thing. 3 rate cuts, but not as soon as the market thinks, and they need to see how things are going to play out. So where do we go from here? I think the markets are biased upwards into 24 and 25, as long as the economic progress stays on track without major disruptions. And I think that's a big if, because you're seeing escalations in the Middle East with the Houthis and what's going on in the Red Sea and the redirection of trade, what's going on there. That's a very volatile area. It behooves Iran and Russia to keep playing the game where you put pressure on Israel from Lebanon, you put pressure on other countries in Europe from what's going on, you put pressure on energy prices, and all of a sudden the will of the West to continue to fight and not deal with their internal problems in election years comes into question. So I think you could make the case for a lot more disruptions because it behooves the adversaries of the West to have that kind of disruption. So going into next year, I would expect volatility to remain high. I mentioned the phrase peak uncertainty last week, and it feels like we're in that environment now. I think the Treasury auctions are something we really have to watch closely to make sure the uptake is there, because if the Fed doesn't get the uptake, rates will have to push up. That could reverse some of the positive nature that's going on. We've had Ed Yardeni speak regularly for ARS. He's one of our go-to strategists with Nancy Lazar and Ed Hyman. But Ed Yardeni has started the year with a call for 4,600 on the S&P. He's now calling for 5,400 for next year with $250 of earnings and 6,000 on the S&P for 2025. The other side of that is Mike Wilson, who has been one of the most bearish market prognosticators, and he's looking at 4,500 for next year with 229 in earnings. And I think a lot of this is going to really depend on what happens with multiples, and that really depends on what happens with interest rates. So I think we're in a really highly uncertain environment where things look really positive and should be positive for some time if things stay on the course that they are. But as we've seen the last couple of years, things don't stay on the course. And just to give you a sense, if you look at the market right now in the S&P, the overall aggregate S&P does not show high volatility. But if you look at the underlying names and what's going on underneath the market, you are seeing incredible daily price moves, particularly around earnings, which show you, one, the power of the quants in taking advantage of or driving the market with short-term trading, which is going to add to volatility as we go into the year. I think this is going to be a really fascinating year next year. I thought this year was going to be really hard. I now fear next year is going to be even harder for figuring out where things are going, because one of the surprises from the Fed in their announcement was that they have inflation getting down to 2% in 2026. Which as we've talked on the past couple of calls, a lot of people have called into question whether we'd ever see under 3% inflation, or certainly whether they would hit the 2% inflation target again. And in their projections, they are looking at that. And I think it's not unfair to say if things go on the path that they're going and we have a soft landing, could you get there? I think is a reasonable view. And that's one that Ed Yardeni's had for some time. And I think that's really what we're looking at is where odds are favoring a soft landing, but the world is sloppy enough that we could get some major disruption. So we would play it, own the themes that you think are going to be endurable, and be prepared for some extra volatility next year. So Mark, I'm going to stop there, and I just want to wish everyone a happy holiday. We'll be talking again on next Tuesday, but this has been quite a year, and thank you all for keep coming to these calls. Appreciate it.
Thank you, Stephen. Yes, early happy holidays, everybody. Mid-holidays. So, Bill, you just joined, but we covered ground that you would appreciate. I was thinking about the Survey 15. Actually, can you do a quick shout out on Survey 15? I'll put it in the chat.
Yeah, no, absolutely. So we've revised Survey 14 to include a couple more questions, and also to get an update from you all with regard to your target or current asset allocation. And as I'm sure Stephen pointed out, lots of interesting things going on with the Fed right now. Conditions are changing so rapidly. It would really be terrific to hear how that is impacting your thinking with regard to asset allocation expectations, going forward into 2024. So take a few minutes and fill out the survey. The link was sent. Mark's got the link. A good number of you also got an email with the link. And so, we're sitting on pins and needles, waiting to hear from you to hear what your thoughts are.
So
And that'll be
standard
all compiled and presented at Miami, correct?
correct, and on an anonymous basis. So
Yes.
Bill doesn't even know who's who when he gets these, and we report it that way. So what scares, excites you, your asset class focus, preference on deals, your biggest priority, and then how you see inflation around the world, rates, and then how have the wars, plural, affected you? Just more of a yes, no. We just ask again if you do have a policy statement, and then your allocations. But yeah,
Can we have a little shout out to Bill for aimlessly and selflessly compiling for the last couple of years this data and miraculously providing very, very useful insights actually for a lot of people on this call.
this
Thank
is
you,
true.
Matt. Good stuff,
I-
Bill.
Yeah, thank you, Bill.
Sure thing.
We
Yeah,
do.
well, I'm already getting material together for January. I'm hopeful that things won't change too much between now and then. But there's a lot of really interesting stuff going on, and we should all be aware.
So back to, I guess, questions to Stephen or to the group. Andy.
Hey, Stephen, obviously you guys are anything but S&P indexers. So I guess it's not on the screen, but it's simple enough to ask. So if you look at a Russell 2000 chart and you look at an S&P 500 chart, they don't look remotely the same. You know, the Russell's nowhere near its highs. Forget breaking any. You know, what do you make of that? I mean, there's probably 10 different things you could talk about, but whatever the top one on your mind is.
I think the overall small cap index is mixed with companies that are in financial positions that aren't established enough to get the growth supporting the cash, the valuations. And I think that is, and if they're relying on the debt markets at all, I think the penalty for the smaller cap companies has been higher. The gap should close, and I think we're starting to see a bit of a broadening out of the market, which is helpful. But I just think it's the difference is really the Magnificent Seven and how much they dwarf and drive so much of the numbers on the S&P. It mitigates what looks like. I think the rest of the S&P looks a lot more like the Russell 2 than the Magnificent Seven do, and I think that's one of the things that's a bit misleading. You know, when in our careers have you seen $2 trillion companies have 50% moves in a year? You know, that's the type of thing. And then on small caps, you've had a company that meets its earnings, but gives a little bit softer growth, and it'll be down 25%. I just think it's the liquidity in the markets is one of the drivers for it. I also think in small cap, and I don't have any backing for this, my gut tells me the rise of private investing, the way it's been to the level it's been over the last couple of years, has taken what were formerly public equity investors in small cap and put them into the private markets. So you're losing some of the support that you would naturally get to close the valuation gap between the small and the large. I think that's one. I think the debt loads on a lot of the small caps are crippling. And I think that's one of the areas that people see a lot of vulnerability. And again, it comes to us, to the haves and have-nots. You want to find the guys in all areas that are going to fit a profile that needs better balance sheets for the environment we're in going forward.
And the companies you follow, you just talked about debt loads. So clearly, like Apple does not have a debt load to worry about. But the other thing that it's mathematical is corporations in high yield are 5 to 7 year average duration. So the interest rate rise happened very quickly. So the refinancing rate for all of those 2,000 companies is sort of a slow burn over 1 to 5 years. I think the average about 3.5. in the companies you follow, do you see debt service as becoming an impact on earnings? I know you follow a subset of what I'm talking about, but
We do, and it's actually one of the things we're really interested in is the companies that have debt that's selling at a deep discount, the ability to take your cash instead of doing buybacks, retiring the debt, and taking advantage of the discount that you're bringing your debt back into, fixing your balance sheet, making your balance sheet healthier in the process, and actually improving the viability of the company. Because I think those that are over their skis on debt are going to get pummeled. And it won't happen right away because their debt maturities are all different, but that we see some companies doing some really smart things in that area and some companies that can't. And I think it's really gets to the haves and have-nots again. You need to have enough growth to support the debt loads, and a lot of these companies are struggling with that. And I think that's in part due to just the way the global economy is working. We have so many distortions in how trade works. Look at energy now, and I saw Michael put the issues with what's going on in the Gulf and the redirecting of shipping, with Maersk out today saying that's going to be highly inflationary, but it also is highly geopolitical and how it's creating challenges. And for companies, they got to start thinking about, they've been trying to get their costs down, and they're going to see some higher cost again. And how does that get passed through? And can it get passed through to the consumers in a higher rate environment? So there are so many cross currents right now. I think you're really going to be, it's going to be much more of a stock selection market going forward, regardless of the market cap or country.
Anyone else? Questions, comments? I am going to be fascinated to hear what Anar Sov thinks about the credit markets.
Yeah, in particular, I think she watches a lot of the public markets, and that could be a somewhat different story than what's going on in the private markets.
Well, technically, her title is the global head of private credit.
Well,
She does both, I think.
Oops.
Mark, we do have a hand raised.
Yeah, sorry. Go ahead, Neil.
Okay, hi, Stephen. I'm also a private market investor, but I want to have your thoughts on so how's the yield curve going forward from here? Do you think it getting more flatter and remaining an inverted side of things?
Mark, I had trouble hearing the question. Was it about the yield curve flattening, or has the yield curve shaped? I missed that.
Yeah,
Sorry.
correct. Yeah. So what do you think the yield curve is likely going to be going forward?
Predicting the yield curve?
Yeah, the yield curve. I think the short end is going to come down. I think the long end is probably. I'm surprised it's this low. Actually, I was actually wrong, because I said it was going to stay plus or minus 50 basis points when it was at 4.5, and we're down 390 or whatever. I think the 10-year will be near this range. I don't see how it goes much lower. I think the short end can come down, but it won't be as quick as everyone thinks. I think the short end will come down in more towards the latter part of next year, and we could make a case. And one of our higher probabilities is that the market's completely wrong on rate cuts, and that we're at a level that might be closer to where the Fed needs to be. So it wouldn't surprise us if we had fewer than 3 rate cuts and maybe none. So that was a contrarian view that we have, in which case the curve would look a lot like it does now.
Got it. Okay. Thanks.
Yeah.
Other-
No, I'm sorry. Just to add, we've been tracking, sort of historical yield curves that were normally shaped, in inflation environments that at this point were not unlike, what we're seeing right now, not kind of, earlier. So, the current yield curve, the spread between, short-term rates in, let's say, the 5-year is
Bill, do you
about
wanna-
100.
Bill,
Yeah, it's
do you want to share your screen?
Sure.
Because I'm imagining what it looks like from our past
It-
surveys.
Yes. Got to change my view here, full screen. There we go. And share screen.
Put you on the
While
spot.
Bill's doing that, there's one thing I would say that I think is a little surprising to me is that we're at rates that are not out of the norm historically. And the economy is doing well and unemployment is near record lows.
Mhm.
So the idea that we need to lower rates a lot is one that you could argue is challenging, but in this where we are right now, you could argue if things get worse and war breaks out and the conflict in Gaza blows up or Russia gets more aggressive or China gets more aggressive, you could make the case where global slowing would come. But we're looking at a pretty healthy economy right now with inflation coming down and growth being relatively okay. So
Right. Yeah.
think about. Go ahead,
And
Bill.
it's really interesting. So you can see here, between, there we go, between the dark blue line and the green dotted line there, which is where the yield curve was just a month ago, you've got a good 50 basis points almost across the entire curve that we've dropped just in 30 days. I mean, that volatility, people who haven't been around, for as long as us, that's like, that makes your hair stand on end. That's crazy volatility for a bond market. And let's see, I happen to have, we get a spoiler alert. Some of the
Spoiler
things,
alert.
yeah, I know. Some of the things I've been looking at in terms of the dot plot, but which is pretty interesting. So here's what I was referring to as far as the historical yield curves. Again, kind of my favorite is the 2005 one when CPI was running at about 3.4. What's CPI running today? Last print was 3.1. And 1998, 1988, following the huge inflation that we had there, even with CPI at 4.1%, we still had a normally shaped yield curve. Admittedly, short-term yields were at 6.5. So you can only imagine if we went to 6.5 and a normally shaped yield curve. We're talking huge increases in 10-year and 30-year bonds. But if I remember correctly, generally speaking, the spread between long-term and short-term rates is about 200 basis points. So the fact that we are, go back to the other screen here. Okay, so the fact that we are 100, let's just call it for grins, 150 basis points of negative, of inversion. That's the word I was looking for. 150 basis points of inversion. And if the normal curve is a positive spread of 200 basis points, so that's 350 basis points of curve movement to happen until we get into a historically normal yield curve. Just let that sink in a little bit. That's enormous. So probably, is that all going to come at the short end? It's possible. At 5.5 minus 350, that takes us down, to 2%, short-term yields. And how about that? Short-term yields at 2%, long-term yields at 4%, which is where the curve is right now. we can bank on that, right, kids?
So two things. One, I'm just happy that somebody has as many tabs as I do open, like you do, Bill. Two,
Yes.
it is 11:30, and I I promise
Yeah.
to shift gears a little bit to another subject, which is what's happening in Eastern Europe, and is there an opportunity to invest there and in companies that are growing out of that region mainly to the US? And that's something that it's a focus. We had our Warsaw event. Zbigniew led us down there. Also, we focused on Ukraine, helping Ukraine. Eddie's been investing in the region for a while. Eddie Vanderpart is on the call, and others. Alexander Kabanovsky's on, and I don't know if Roman Nikitov's on. He had threatened to join. He was a former colleague of mine at Arthur Andersen, Ernst Young, and really did well timing the market. And now he's got a portfolio of 30 companies in a Ukraine plus strategy, which basically you can't invest in companies that are in Ukraine per se. It's in war, but you can invest in Ukrainian companies that are in Poland or expanding to the. So it's an interesting time, and I think what Europe doesn't have, as well as the US, is growth capital to take you from the startup to the Series A to the public markets, and therein actually lies an opportunity. And Zbignew's got a really interesting platform to help the Polish community connect globally. And maybe you can if you could just reintroduce yourself, Zbigniew, and talk about how you see the Polish opportunities or East European opportunities. Then I want to let some others talk about that, and then we'll circle back to what you're going to be doing in Miami on February 1st after our event.
Yeah, so hi everybody. You, Mark, and Eddie, you've been to Poland and you've seen the situation. The country is really developed. Of course, we suffer because of the war in Ukraine, but in some fields, we also benefit from that. A lot of money comes to Poland. And what I would concentrate is that we have a new government for the next 4 years. And with the previous government, we had some issues with the legal issues with the European Union. Now the situation is solved, which means that we will get $60 billion euros from European Union, which was frozen for more than 1 year. So the economic situation is really good. There's a lot of opportunities. I would also mention that we have a really great, innovative young people. Just like a fun fact, I just saw recently, I don't remember for how many years, but the statistics from the universities IT competitions. University Warsaw is first, Harvard University is second in the world. So we have a lot of talented people. We will present this market situation, everything in Miami, and the values of the companies in Poland. It's relatively so cheap that bringing them to the global level or to US market will bring a lot of profits. So there's really a lot of opportunities, and there is a lack of professional investors, especially in the later rounds, and there is lack of money. So there is also opportunity. There is no big competition. There is more capital with seed or round A, but going B and C, there is less and less competitors in Poland. So these companies are really looking for the investors, and there is plenty of really good companies.
So let's go around the houses, and I want to just other people's views and their experience on Eastern Europe. And I'd asked Eddie to join because he actually has been working with a Polish American family office.
Yeah, so interestingly enough, I'll set the table a little bit to give some sort of macroeconomic data. Not everybody knows Poland and would figure it out where it is on the map, but it's about 40 million people. The historical growth rate of the GDP corrected for purchasing power parity is actually almost 4% over the last 14 years, which means it has almost doubled. And there's almost no country of size that has done that. And it's now even threatening to take over on an adjusted base the UK in about 5 to 10 years.
Wow.
It attracts a lot of multinational corporations, R&D centers. Intel, Cisco, Samsung, Microsoft have all made multi-billion-dollar investments over the last couple of years. And that's partly because there's a ton of graduates, particularly STEM graduates, every year. About 1.3 million students, 300K graduates per year. And it's known for a lot of production, which it does very well. But also in terms of R&Ds per 100,000 people, it almost eclipses my home country, the Netherlands. And in a couple of years it will, which is striking, and you would not per se get that. The venture early stage venture market is pretty vibrant. It's about 750 million investment on the last couple of years. It's been growing very fast. But like Zbigniew said, there's not a lot of sort of follow-on capital, and that's where one of the things is where we could jump in as a investment group and get the most attractive Polish companies to move here, and to sort of set up base. And there is indeed, I agree, is a tremendous imbalance, and if you like, arbitrage opportunity in general for European companies, but Eastern European and Polish companies in particular, where the valuations locally are much lower and here much higher for the same quality of company and the same quality of technology. The entire region, sort of, if you include Romania, Hungary, etc., is about 1.2 trillion. So that's sort of comparable to, let's say, Canada. And so it's quite large and sort of undiscovered for a lot of Americans, but it's a very interesting country. It's really growing fast. If you go now to Poland and you compare it to 15 years ago, it's wildly different. So it's for me it's very attractive, and I'm joining Zbigniew in his sort of motivation to sort of try to pull a couple folks together and invest in this.
And there's another voice perspective that's perfect. Is Alexander Kamenovsky, who sits in Berlin and goes back and forth to Warsaw. Maybe you want to chime in, Alexander?
I don't think that I can add significantly to what Zbigniew and Eddie have already said, because you know my view on the Warsaw market and the Polish market. I've been very actively working with Polish startups for the last 8 years, and obviously it's been incredibly impressive to see, especially if you can contrast to what I've seen in the startup ecosystem in Berlin or in Germany, the vibrancy and the innovation that's coming out of Poland, and the most interesting thing is that it's all homegrown. These are young people who are taking the initiative on their own, and coming up with some incredibly innovative ideas. And what they do with the amount of money with the amount of capital that they have available is extremely impressive. It's been a dream of mine to try to find some way to give them the opportunities and the capital that they desperately need in order to push these ideas and these businesses forward. And I think it's also incredibly important to mention the fact that there's a real entrepreneurial spirit that exists in Poland, which, if for anyone who's familiar with Europe, that's a very, very high value commodity that's not easy to find across Europe. I mean, people work, and people are energized, and people really do want to find solutions and to see results. And I think that echoes sort of this American spirit of investment and growth. And I think that we have to find a way. I mean, I'm very passionate about this, and I've been trying to find a way to marry these two very natural, I think, and very complementary environments and ecosystems to really harness the capacity of the U.S. market, especially when you compare with the valuation parameters that you see in the United States and the valuation parameters that you can get in Poland. It seems to be a no-brainer, but once again, there are these, I guess, mental barriers that are difficult to overcome. And I welcome Zbigniew's initiative in this event that he's holding in Miami, and I hope to be able to attend, but just in case. Anyway, that's the view from here.
But Alexander, thank you for that. But I agree that what Eddie said, the market is undiscovered for the American investors. Opportunity is there, people are there, companies, and everything is there. We have investors in US, and I'm asking myself why there's so little investments and connections, which means that the American investors probably do not believe, do not know this market, do not want to invest, do not search for these opportunities. And because there is so little investments, the Polish companies, they dream about the US market, but they do nothing to find the good investors from US market. So we have like only maybe one example of unicorn, Buxi, the guy who moved from Poland to California, now he's in Miami, and he did a very good job. So we have a first real example how it goes and how he grows his company. But we need to find a way how. This is the most important question for the meeting in Miami, to find the way how. If we know how to do this, we can, bring a lot of nice project to US.
So a couple questions, hands up, Michael and Andy.
I just had an underscoring comment that I think might help perspective, and it's 2 seconds long. When I left State Street in 2015, a company not known for being the most progressive expansion into frontier markets, there were about 1,000 people in Poland. Today, there are almost 7,000 employees in Poland from State Street. And what that tells me, knowing the organization, is that they had no trouble getting a workforce to do whatever it is that they needed to do. So I'm just underscoring the comment. The people are absolutely there, and that's how I know it.
Thank you.
So there's no question about the human resources that are available in Poland.
Mm-hmm.
Extremely impressive.
I'll agree with Andy. From my last corporate job, I worked with developer teams pretty much from most countries that you'd expect around the world. And the European ones, Eastern European teams, highly skilled, committed, doing a great job. But what I was going to say is, I participate Angel Capital Association, other groups like that, and I see Israeli startups where they have a parent company incorporated in the States, subsidiary back in Israel, things like that. So that's one model to look at. A lot of investors, for example, like myself, I really try and avoid having foreign holdings so I don't have to deal with the government reporting. And so I realize it's difficult for Polish companies, Ukrainian companies, wherever, to reach out and participate in events in the US in the venture startup space. But that's really what they have to do.
Well, that's part of what we're doing. We're building that bridge. Anna.
And I apologize for background. I'm going to cover my microphone. This is a great conversation. And having come from Russia myself many years ago, and knowing people from Eastern Europe and knowing people from Poland, I know this hesitancy of really establishing that connection and bridge and going after the US capital to grow the businesses. It's all mental. It's not the skills, as you mentioned, the skills are there, but it's all mental blocks that come. These are generational blocks, and also as we grow, social and cultural. And the good thing is they can be cleared. We can get through that, because those inner blocks, no matter how much capital people are going to receive, the mental blocks, if they're not cleared, they are going to create resistance in the growth possibilities, in the potential of growth. It's all kind of energetic blockages that we set for ourselves. So even though you may have like the biggest investment into those companies, the startups, if the mental self-doubts are still there, it's going to limit the potential for growth, or it will make it very difficult. Does that make sense?
Yeah. Anyone else with a comment? Yeah.
I'm curious if there's any directives at the Polish government level where they offer some matching non-dilutive financing, because I've seen some other countries do that, and that tends to attract a lot of investment into the area.
So I'll let others comment, but I think it's yes and no. They offer that, but it's challenging. They even offer grants. Slow process, bureaucratic process. They also have been backing funds. Mainly these are either the startup stage, and they may be partly into the or in the private equity stage, but this growth equity is where we're not seeing it. And others can comment on that.
Well, if I may just quickly, the government does provide grants, and there are EU grants. The problem with these types of programs is that they are so bureaucratically onerous that the reporting on the funds it takes up just administrative time. It takes up it's actually quite burdensome financially, and at the end of the day, it doesn't lead to because the grants are not investment capital, and because the government does not have experience in supporting startups and providing the value added that you would expect from a qualified investor. It's actually quite a dangerous tool because it gives you a sense, or gives companies a sense that, yeah, we've got some capital to work with, but then sometime 6 months, 8 months into the process, they realize that, oh my God, I need to start getting the documentation in place. I haven't hit my milestones. There's constant sort of issues and barriers that crop up, and that actually make them they make them onerous and what they shouldn't be. And then you've got companies that are more focused on trying to clear the hurdles with the government reporting than actually hitting the business milestone or raising new capital that is hard to come by in Poland. That's the real problem as well.
So
it's just hard to come by with additional capital.
But again, therein lies an opportunity. Now, Walter, you've got a question, but I want to. Roman Nikitov has been trying to join for 20 minutes here. Hi.
I'm sorry, guys.
So
bad connection.
So I love that you can join our group here. You're like a success story in many ways of someone who, first of all, we were colleagues at one point. You've done really well as an investor. Then you've been investing in a lot of startups in Ukraine, Poland, moving around. So I'm sure in some ways you're inspiring to the Ukrainian entrepreneur or the Polish entrepreneurs. Just introduce yourself. We were talking about the stage of capital. You're at that earlier stage, but a lot of your portfolio companies are trying to expand, and there's this. Trying to get across the river, over the mountain, into the U.S. or into other global markets. Maybe you could just explain your perspective. And Eddie, you haven't met Roman. You're gonna enjoy this.
Okay. Yes, guys, and I apologize for taking time to connect.
I may take your video off, because I know you're.
I decided to take it worked. Okay. Okay. So nice to meet everyone. And I know some people, so nice to meet those that I didn't meet so far. So basically, yes, I've been investing in startups. It's venture capital investing since 2018, and we have two strategies. And one of the strategy which is relevant to this conversation is the strategy which we called internally Ukraine or CE Global SaaS strategy, where we would invest in companies that would start getting revenues and would at least have 50,000 ARR, would not necessarily have the global scale at the moment, but would have an ambition to scale globally. They would have clients and generative revenue clients in the local markets, whether this is Ukraine or Poland or Romania for that sake. But then we would ideally want to catch those companies that have developed their go-to-market, have tested their product against the local client, and have ambition to scale. Ideally, that would be something related to deep tech. And we haven't figured deep tech angle at the beginning of our investing back in 2018, and we've kept it a little generic, while from day one we were confident that B2C is not for us. B2C is sort of, if I put it bluntly, sort of marketing, marketing expenditure wars, which we're losing. I mean, we coming from Eastern Europe, we're losing anyway to markets where investors with deeper pockets are just closer. So no illusions here. That's why the competitive advantage that we saw with companies that are coming from Eastern Europe, Ukraine or Eastern Europe, was exactly the deep tech or kind of hard to copy angle, where there's nothing impossible in this world to copy, but it does depend how much time it will take and how much resource. So hard to copy is one angle, and another one is basically the right for mistake. So if you're in R&D, many companies at this stage, they pivot, they change, they try to survive, the market collapses, and then COVID happens, not naming wars and stuff like that, but there are multiple disruptions, and these companies have to survive, and the cost of survival, cost of kind of adoption, cost of pivoting, cost of mistake, what we call, is much slower, much smaller in Eastern Europe. So far we have invested, overall our portfolio is 30 companies, but at the moment with the global SaaS, Ukraine global SaaS, Eastern Europe global SaaS strategy, we wouldn't necessarily stick to Ukraine, by the way, in our strategy, but the pipeline that we've been building naturally has been focused on Ukraine because we are based out of Ukraine. So the biggest flow of the companies would be from Ukrainian founders. Then maybe, Mark, should I stop here or should I continue? I mean, I just don't want to go off the topic.
So you've been in the trenches, and one subject is, these portfolio companies. What are their options for getting growth capital, not even to the pre-IPO stage?
I mean, next stage. I mean, how do we attract capital to the next stage of development?
Yep.
Well, basically, in most cases, the Ukrainian startup, which is a bit of a difference with Polish startup, is that Ukrainian founder doesn't have any illusions, didn't have too much support from the government up until lately. Right. So the first.
I remember this discussion.
They registered Delaware Corp. Yeah, yep. Delaware Corp. So that they're making themselves available for, let's say, U.S. capital and whoever else. If you're Delaware, then you just don't have these issues of IP rights. Once you develop them, you don't have many issues. It's understood by US or European investors, while investing in a local company in Ukraine, even before the war, has been very difficult. People would try to understand how the law works. Does it actually work? Is it scary? Is it not scary? Is IP right protected? I mean, there are many questions that are just redundant, and people from investor side, they just don't have time to kind of get their minds, around this topic. So the typical Ukrainian startup would just have R&D in Ukraine, would have contracts with Delaware Corp, and then attract money. So the next stage of development would not be, I mean, there's nothing technically kind of from a legal perspective that would hinder the process. The only thing that would help is basically the growth profile of the company itself, the traction. So if the company demonstrates traction, let's say we enter at 1 million ARR, and the minute we reach 3 million ARR, the next stage, I mean, there is a whole new universe of investors that are looking at 2 to 5, then 5 to 10, then 10 to 20, and they just don't want to spend their time, looking at the smaller deals. So it's like this phases of development. So you reach 1 million, then you reach 3, then you reach 5, 10, whatever, and you go up the races.
Wanda has a question.
Not that much question. I'd like to make 2 quick comments as we are going to the top of the hour. The first one related to Michael Hammer, business model concept. To American investors who want to take advantage of those opportunities, because there are true opportunities, there is this anxiety about operating on the local markets. And I think Israeli model was an excellent example of how investors could approach it correctly. But Israelis have this mindset since the beginning, small country with global view. Polish view is we have a large domestic market, relatively large, which is 40 million people, plus easy access to EU. So expanding to other markets presents a lure, but it requires different mindsets. So I'm very much in favor of, for American investors, of setting up an entity in the US with a connected entity in Poland. It has number of advantage. Once in terms of governance, the Polish laws, like French laws, like Eddie helped me out, I think Dutch laws, they're still somewhat protective. You have to document the efficiency in the local language to sit on the board and so on. So there are ways of going around these issues with, again, the controlling entity in the States. So the other comment, very quick comment, there was a lot to be said about human capital. I haven't done hands-on work in quite a few years in Poland, but I just reviewed another statistics in terms of productivity survey. Koreans are #1 globally in terms of being highly evaluated as employees, and Poles are #2. There was a lot to be said about entrepreneurship. From my times in Europe, I remember that we talk about 2 mindsets, one American entrepreneurial, the other one German, Austrian, which is, strict hours, no works on Saturday, Sunday, stores are closing. This is not Poland. So from my time, Poland was very closely aligned in terms of the business mindset with American entrepreneurial mindset that also can present advantage to American investors. And we are getting to the top of the hour.
So-
Thank you.
And you spent a lot of time in Russia,
Yes.
as did I. How do you compare the Polish mindset with the Russian and the Ukrainian mindset? You heard what was, I think it was Roman was talking about the difference between a Ukrainian startup, they're under no delusions. Like they have to get to MVP very fast. They need to get to the market very fast. They use a dollar as the Poles might use five. But how do you compare?
With regard to
You can skip Russia if you
you
want.
said,
We're not investing in Russia.
yeah, it's still a very corrupted economy. It always has been. Certain things were not transparent, and I do not expect major changes in that mindset. I think my Ukrainian experience is limited. I haven't been doing business in Ukraine in 10 years or 15 years, but I think Ukraine grew up in business in trenches. So there's this pragmatism and the willingness to succeed, when in Poland, you can still look for support from different organizations and the capital. Ukrainians are very pragmatic. And again, it's a wartime, so investing in Ukraine, I think you have to have a stomach for that and really good understanding of the market and the trust level among your local employees, because you cannot control how the capital is being spent, at the level that we would like to have a control over in the US, for example.
Yeah. Eddie, if we do something, I see Wanda as being on some of these governance boards with us. She's going to make sure the money's spent properly.
Yeah, absolutely. And she can advise on the right governance structure, and that is an issue. And I think that there's several solutions for that are handily available. And I think she'd be excellent, collaborator here.
We'll be glad to confuse you.
Thank you.
May I, Mark? May I comment on this money control and stomach for Ukraine comment at the time of war? Because I think there's a bit of we just need to be very clear. What does it mean to invest in Ukraine? Invest in let's say private equity investment with a heavy asset business, and what does it mean to invest in a Ukrainian startup? Ukrainian startup, even before the war, as I mentioned, has not been registered in Ukraine as a legal entity.
You're coming out. Roman, you're coming. I think we're gonna have to. No. Well, maybe now. Try it again. Try it again.
Okay.
Basically, the Ukrainian.
Okay, I'll try again.
Entrepreneur.
Okay, cut me off if.
Okay.
Yeah. Apologies for that. So in that sense, Ukrainians have been following, so to say, Israeli model, where there are no disillusions, there's no market, not big enough, let's say, but big enough to test it, to experiment, to find first clients, and then go straight to US without going into looking for support somewhere in EU, for the programs, grants, Ukrainian government. I mean, nothing. So we were making sure that those companies that, as a local investor, those companies that do have good technology and do have good traction with the local client, they basically survive till the next best investor in the US. So we were sort of bridging that that area from late seed to round A, where we know there are going to be bigger investors, waiting in the US if the company is demonstrating traction. And from a US investor perspective, there's no difference. The company's R&D is coming out of Ukraine or anywhere else. You know, if it's succeeding in the markets, they understand. It's structured in the markets, they understand, and you know, it demonstrates you know, good track record. You know, that's good enough.